The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, a certified financial planner at Galileo Capital. Warren, good evening. Nice to talk to you again. Discussing this evening the best ways to invest money overseas. And I suppose one of the first questions we would have to ask is why you would want to do that. And knowing you as I do, I'm sure your answer will be to diversify.
There we go, Stephen. It's a whole universe in one word: diversification. And I think it's true, but maybe just to elaborate a little on that, when you look at the South African Stock Exchange, you would see a bunch of companies that are, I mean, most of them I think are actually extremely well run, but there is a large focus on banks, on insurance companies, mining houses, and then a few other businesses around that. But what you won't see, for example, is a big tech platform, like a Meta or a X or something like that. You also won't see a massive global biotech business that's developing medicines for today and for the future, and then a host of other companies that that are maybe changing the way we do things, and might be changing the future. And most of those companies are listed in places like the US, like Switzerland, the UK, and right across to China. And so I think diversification is also about having access to companies that that offer opportunities we can't get on the South African market. So I think that's one big reason, but also accessing countries that have different interest rate markets. So for example, being able to buy bonds in Brazil if you really wanted to do that, or being able to buy a money market unit trust in Switzerland if you just want absolute safety. So there are a whole range of investments that you can access that look very different to what we can get in South Africa. And I always think when we talk about this, people tend to be a little bit binary. They go, we either invest in South Africa or we invest overseas. And if you're investing overseas, it's not patriotic, or it's a call on the future of South Africa. And I think those are truly rubbish arguments. When you're investing, I think if you live in this country, if you live in South Africa and you're going to spend rands for the majority of your life, you certainly need a significant portion of your money in the country and invested here. But at the same time, you always want the opportunity to benefit from economies and markets that perform differently and also at different times to the JSE. And hopefully, over a very long period of time, if you do that, then you get to the situation where 1 + 1 = 2.25, and that quarter is free because that's what comes from diversification.
I like the way that you put that. For a lot of us, when you start and you want to do something slightly new, you start with a sort of small monthly payment. Quite difficult to do that overseas.
Absolutely. And I think it's one of the myths now. In the past, when the opportunity to invest overseas first opened up to South Africans, and that's way back when I still had all my hair, it was really kind of an opportunity for people with a lot of money, and I think for a lot of South Africans that sense of elitism still applies, and I think that's not true anymore. You can really access global investments with a monthly debit order now, and it could be as much as, or I should say as small as 500 Rand or a lump sum of 1,000 Rand. And so understanding that access to global investments is a lot more democratized than it's ever been before. And most of us, when we start investing, we're not going to have 5 or 10 or 100 million Rand lying around. What we're going to have is a couple of hundred or a couple of thousand Rand a month. And then I think, understanding that, you can actually take that money and invest in global markets. And for a lot of us, that we might access those global investments from investments with a terrible name. They're called feeder funds, and it's not because they're going to eat all your money away. It's because you take your Rand investment and you feed it into global markets, and you can do that via a unit trust or an exchange traded fund. And what will happen is, let's say you choose a world index. You'll put your money in rands into a unit trust or an exchange traded fund, and that product will then go and buy the world index on your behalf. And so what will happen is if the world stock markets do well, you'll benefit from the growth of the world stock markets. And then if you put your money out and it's whatever it is, let's say 19 Rand to the dollar today, and in 5 years' time, it's 25 Rand to the dollar, then you'll also benefit from the depreciation of the Rand. If the Rand goes from 19 to 14 in 5 years' time, then you will lose on the value of the exchange rate actually strengthening. But the point is you get the diversification of exposing your money to global markets and then hedging the Rand out against the dollar or the pound or the euro, whatever your choice is. The key there, Stephen, is when you decide to access that money again, so you say, now I need to draw some of it or all of it back, you're not going to be able to pay that into a bank account in Switzerland or in the UK or in the US. It's going to be paid to your South African bank account in good old South African rands. So it is a way of getting good investment diversification, but it's certainly not a way to go and spend your pounds and dollars overseas. You won't be able to do that.
Okay. When you invest in these funds, I mean, do they cover the whole world, or are they really sort of kind of Western based? And I imagine the big focus on America at the moment. I mean, would you get exposure to China as well, is what I'm asking?
So this is where we're now exposed to an absolute world of choice. We can choose, for example, a world index, and the world index will measure the value of all of the big stock markets around the world, and so and give it the weight accordingly. So if the American stock market happens to be the biggest part of the world stock markets, and let's say it's worth 70% of all world markets, then when you invest, you're going to get a major US exposure, and then you'll get the relative values of the UK stock exchange and European all the way through to China. And an index like that, I've been talking about the world index, but the one that you would look for in that instance is called the all country world index, because then it is what it says on the box. It covers all the countries in the world. You can also decide, I'm going to choose an investment that's got a specific focus, for example, only on Asia or only on emerging markets or only on Europe. So you do have a significant choice when you make these investment decisions. And equally, you might decide to choose a unit trust, which is global, and the fund manager that you select might say, we believe there is real opportunity in China and in India and maybe in Europe, and we think there is much less opportunity in the US, and then your exposure might be a lot less to the US. And then lastly, you might be, rolling the dice, and I'm using those words on purpose, and saying, well, I'm actually going to put all of my, feeder fund exposure into US tech shares because I don't think they're expensive enough. I think they're going to get a lot more expensive. I hope people don't make that as their only investment decision for overseas, but they can do that. There is the choice.
A lot of it is also about how you do it. So we've been talking about sort of smaller monthly amounts, but you can also invest larger lump sums as well. It could be a bonus, could be you save up for it, could be from the sale of a house, something like that. Is that a bit easier?
I guess I'm hesitating in my answer because it could be easier and it could be a lot more complex. I think just to explain the difference, what happened quite a few years ago was that SARS said there is this thing called the travel allowance, and a lot of people were using some of their travel allowance to actually allocate money overseas and often just in bank accounts, etc. And then they weren't really reporting those assets back to SARS, so it made things quite messy. And SARS was very pragmatic to say, we're going to now increase that allowance, and it's now at the moment R1 million a year, and we're going to call that your discretionary allowance, your annual discretionary allowance. So you can use that, some or all of that money to travel if that's what you want to do. You can use that money to buy goods overseas and bring them into South Africa, and you can also use that money to invest overseas. And what will happen is you don't need to apply to SARS for special permission or anything. You can simply use your South African bank or your South African foreign exchange dealer. They will then note that you've sent the money out, so they keep track that you're not doing more than R1 million a year, but you don't need permission. You can simply do it. And if you are investing, what's important to remember is that money doesn't simply disappear off your balance sheet and SARS doesn't simply forget about it. They're going to find out about it because the foreign exchange dealers have noted it. So it will become part of your assets, and in future you would report those to SARS. So that's a fairly easy process to follow, and we can do R1,000,000 per year without asking for permission. Just be careful that you don't do R1,000,000 at the start of the year and then remember that actually you needed to spend 100,000 of that money on travel, because now you're going to exceed your allowance. And so that's a problem you don't want to fall into. But if you do have a large amount of money, more than R1,000,000, you can apply to SARS to get an allowance to send up to R10,000,000 per 12-month period. So it could be, the end of February to the beginning of March next year, or it could be the end of June to the beginning of July next year. It doesn't matter, but you can send 10 million rand per year. It's a slightly more tricky process because now you're asking SARS for permission to send that money out. And one of the things they're going to check is, are you a taxpayer in good standing? So have you done all of your necessary taxes? And secondly, are you able to prove the source of wealth? So if you've only ever told SARS for the last 30 years that you've been earning R5 a month, and you suddenly apply to send 10 million rand overseas, you're going to have some very good explanations as to where that money came from, because it doesn't look like you've earned it. So I think there are two ways of getting that money overseas, Stephen, but can be easy if you're a taxpayer in good standing. Sometimes SARS is a bit busy, and then that special permission takes a bit of time. I think the one thing I want to talk about with this, though, is be careful of sending out lots of amounts all the time. In other words, the fact that you can send R1,000,000 a year, don't suddenly now go and send 100,000 rand at a time every 2 or 3 months because you want to smooth out the effects of exchange rate movements or something. Because every time you convert your rands into dollars or pounds or euros or yen or whatever it is, you are paying the banks a fair amount of money to convert your money into a different currency. So I think larger amounts make sense because at least you keep your costs down.
You also need to be aware of the tax implications of overseas money, right? I mean, it still attracts tax in some way.
Yeah. I mean, you will know that I'm a huge Warren Buffett fan. So the temptation for me and a lot of other Buffett fans is to all go and allocate some of our overseas money to buying Berkshire Hathaway shares, which, maybe it may not be a bad idea at all, except for the fact that those shares are listed in America. And what you need to know about America is if you die in South Africa as a South African resident paying South African taxes and your investments of American assets exceed $60,000, you are liable to pay the American tax authorities 40% estate duty on the amounts over $60,000. Now, there's a bit of a sliding scale, and it's complicated because we're dealing with America. But the point is, you could be in a position where you're giving away a huge proportion of your estate to the American tax authority, and you've never even potentially been there. So, and similar kind of principles apply, for example, to the UK, where the amount is £325,000, which is a lot, but still applies, and it can apply to a lot of other countries as well. So investing overseas, when you're buying in hard currency and you're allocating money there, is a very good idea, but you have to choose the domicile, which is just a fancy way of saying the home of that money. And you really want to look at places like the Guernsey, Jersey, Isle of Man, Switzerland, or Ireland, because those countries are well regulated, but they don't charge these kinds of taxes on non-residents in those places.
Sure. Amazing what the Americans get away with. There's a question from Brahm for you this week, Warren. He says, I've just started my first job this month. My boss is telling me to get a will. Why? I don't own anything, and I have no wife or children. That's from Brahm. We'll have an answer from Warren Ingram, co-founder of Galileo Capital, in a moment.
The Money Show. Personal finance with Warren Ingram.
Warren's co-founder at Galileo Capital. And Warren, we had that question from Brahm. His boss is telling him to get a will. It's his first job. He says he doesn't own anything, has no partner, no children. Why would Brahm still need a will?
I just want to say I think Brahm's got a very smart boss. It's one of those things that's a real tragedy in our country where I think that I mean no one's ever quantified it exactly, but it's comfortably more than half of all adult South Africans will die without a will. And when I do talks to people that are salary earners, and I ask them by show of hands just to put up their hands if they have a will, it's very rare that it's more than half the audience, and those include parents, grandparents, etc. So Bram's not alone in wondering why. And I think, just to understand, if you're over 18 years old and you die without a will, what happens now is that the law says you've died intestate. That's the jargon for it. What it really means is now it's up to a government department, government officials, to decide what will happen to you and and by that I mean your body, like what will happen to your remains and what will happen to the stuff that you have. And if Bram's saying he owns nothing, I'm wondering if he doesn't have a special collection of radio controlled cars or caps or rugby jerseys or whatever it is. Everybody owns something, even if it's not a lot. And now it's up to a government official in a department that's unfortunately notoriously not well run. It's called the Master's Office, and they're hugely overworked. And now they've got to decide, without knowing anything about you, how you're going to how your remains are going to be processed. In other words, are you going to be buried? Are you going to be cremated? And now you're stuck in a massive bureaucracy. And if you have anybody that cares for you, this is traumatizing for them. So, if you don't think you've got a lot of assets, that doesn't excuse you from not having a will. At the very least, you want to stipulate in that will what happens to the stuff that you do have. Should you leave it to your family or to a charity or anything? It doesn't matter, but at least write it down and make sure it's in a proper will. And then, really importantly, what should happen to your remains? Do you want to be buried? Do you want to have a religious ceremony? Do you want to be cremated? Those are things that need to be specified there, at least to know that on your death, the people that are left behind at least know, number one, what you want to do, and number two, that they have the authority to make it happen. And so I think it's a key thing. And at age 21 or 18 or whatever it is, when you start work, you might not have anything, but the reality is, if you do earn an income and you start accumulating assets, at what point are you going to decide then to have a will? And most people will forget this. So I think it's good practice for all of us to have a will as adults. And the reason I specify that is, if you die and you're under 18, at least your parents can execute their authority and make those decisions on your behalf. But if you're over 18, they don't have the authority. And as I said, the Master's Office is not run well at the moment. It's not a good place, and you just don't want to leave government officials to do this. Even with the best will in the world and the best intent, they're not going to get to this quickly, and they might not make the right decisions. So, Bram, please get a will. You can go to a law firm. I know most of the banks will even do one for free if you appoint them as an executor. And that might not be the best will in the world, but it's way better than no will. And please don't try and do this as a DIY project, because there are some legal criteria around this. They have to be witnessed, and the witnesses can't be people that are going to be benefiting from your will. So there are some criteria around this. But get a will, Bram, and everyone else that's listening, if you haven't got a will, maybe make that your second New Year's resolution.
It's also, despite some of the technical stuff, it's quite easy. You can sometimes get a will. You'd need to just check that it's the correct one, but you can get literally a blank one and fill it in. It's that simple in some cases.
I suspect so. I think in the old days you could go to kind of your local stationery shop and they would have some on template there. I think again it's better than nothing, but just make sure that you understand all the criteria for what's required in a will. But gee, paying if you've got the money to pay someone to draft it, an expert to draft it, then do that. But if you don't have the money, just get one from the bank. At least it will be done in the correct form. And then maybe also importantly, you don't have to do anything to that will if you decide to change it in the future. In other words, if I write a will now in 2025 and I decide to update it in 2029, I can automatically, as part of my will, say that all the previous wills are now null and void, and this is the correct one. So it's worth doing and checking every 2 or 3 years as your life changes.
Warren Ingram, thank you very much indeed. As always, really appreciated. Co-founder at Galileo Capital, financial advisor, and of course fascinating to hear about different ways to invest the money that you have.